Hi Simon, how are you?
Hi, Emily. I'm well, thank you. How are you?
Not bad, thanks. So look, everyone's talking about wealth taxes. Why is that?
Well, yes, as the OECD has fairly recently reported, wealth continues to be spread more unequally than income in most countries. But despite that fact, countries have over the last couple of decades generally abandoned wealth taxes. A review in 2011 suggested that the government should consider taxing wealth more effectively, both on efficiency and equity grounds. And so this idea has been mooted for a little while. And obviously, the shadow of the global financial crisis has been long and felt by a lot of people. And the perceived intergenerational inequality that has arisen continues to be a rallying cry for certain interest groups, both outside and within Parliament. And now, with the economic havoc being wrought by COVID-19, governments of all stripes will be looking to repay the huge borrowings that are currently being made. And I think in that context, that is why the question of wealth taxes are being raised. But Emily, would a wealth tax, if it were introduced in the UK, be all that novel? Has anyone previously suggested one?
Well, it was actually in Labour's 1974 manifesto. The Harold Wilson government didn't manage to implement it. The plan rather hit the buffers after some rumblings from the Treasury, and it was formally abandoned in 1976. And since then, no government has formally proposed the wealth tax. Of course, in Labour's 2015 election manifesto, there was the so-called mansion tax, which was in some respects a bit like a wealth tax, but in other respects not. My understanding was, for example, you weren't going to be able to deduct the value of a mortgage on your home. But of course, Labour didn't get in, and so we never got to see the detail of that proposal. So, Simon, they do have wealth taxes in some European countries. Where's that?
Well, that's right. There are, but only a few. In Europe, the three main countries are Spain, Switzerland, and Norway. Portugal and France do have a form of wealth tax on real property, but as I said, Spain, Switzerland, and Norway are the main ones. In Switzerland, of course, the rate is very low and the tax regime generally quite favourable to taxpayers in any event. Spain provides quite a good example, I think, because the wealth tax there was reintroduced in 2011, as with all great taxes, only initially as a temporary measure, but has remained in place ever since. Now, in Spain, it applies once a person's assets are in aggregate worth over €700,000, and the rate payable ranges between 0.2 and 3.5%. They have an allowance of €300,000 for Spanish residents against the value of their main home, and that's double for couples. France also provides an interesting example because they've radically reduced the scope of their wealth taxes quite recently. Now, it's only payable by French residents on worldwide real property worth over €1.3 million, or for non-residents if their French Cyprus real estate assets are over the same amount. And before 2018, France's wealth tax were very much greater in scope. But generally in Europe, the trend has been away from taxing wealth. In 1990, 12 countries did so. As I say, now it's much fewer. So, Emily, if the UK were to consider introducing a wealth tax, how do you think it might be structured?
Well, I would expect it to be an annual tax, a lowish percentage on the worldwide assessed value of chargeable assets of UK residents. I'd expect the value of property such as land would only be reassessed periodically. I would expect that borrowings should be deductible, especially if they are charged on assets. And I would expect some minimum threshold so that probably the vast majority of people would be outside the tax altogether. Now, I've said chargeable assets, some assets are likely to be exempt. So, I mean, Simon, can you tell us what you think that might be?
Well, I think the first obvious category would be assets that are held by charities. I'd expect almost certainly they would be exempt. Other assets that might likely fall within an exemption are, I think, those assets that the government has historically wished to treat quite favourably from the tax regime. So, for example, agricultural land we might expect to be exempted, perhaps assets of certain small businesses, new startups and so forth. I'd expect that there would be exemptions for non-domiciliaries with offshore assets, as in the case of property tax in Europe. In France, for example, those who aren't resident in the country in question only pay taxes on the value of the onshore site as assets, and I'd expect a similar sort of regime to apply here. We might also find that a person's main home is exempt, as in the case of CGT, though of course that would have the effect of excluding from the scope of the tax the bulk of most people's wealth. So perhaps what we might see is some sort of form of allowance, similar perhaps, for example, to the resident nil rate band in IHT, for example. So those are some of the exemptions I think might apply. Emily, what sort of problems do you envisage there might be with collecting a wealth tax?
Well, of course, a wealth tax is a dry tax in the sense it's not dependent on any transaction or any actual cash emerging from anywhere. So it's not obvious how a taxpayer who has high value illiquid assets but a low income is actually going to fund the tax. I mean, the most obvious dry tax we live with is council tax, but because that's at a level comparable to utilities, then one can suppose that most people will be able to afford to pay that out of income. I'm not sure the same would be true of a wealth tax. But I would expect that people who can't afford to pay a wealth tax will take steps to avoid it altogether. So have you got any ideas what they might do?
Well, it seems to me, Emily, that there are a number of potential opportunities for minimising liabilities to a wealth tax, some of which would likely be legitimate and some would probably be illegitimate. I mean, one obvious example to reduce the value of your wealth would be by mortgaging your assets and then transferring the net proceeds arising from that disposition either offshore or to family members or connected companies whose liabilities to wealth tax might be lower, or where there are exemptions, or, for example, nil rate band types have not been used up. That might be one potential avenue. A second and perhaps rather more creative avenue would be creative accounting and valuations. I mean, some assets would be very difficult or expensive to value, for example, unique or historic assets, and we can anticipate, I would have thought, that self-certification of the value of certain assets would probably be practically required in most cases. It's unlikely that HMRC is going to be able to challenge any more than a small minority of valuations, and even then valuations, of course, an art, not science, and so one may well see people trying to give lower valuations that perhaps others might ascribe to certain assets. Those are, I think, just a couple of the examples. On that note, Emily, what do you think some of the political risks associated with a wealth tax might be?
Well, I would expect that in abstract, a wealth tax would be pretty popular amongst the base of left of centre political parties. Obviously, what happens in abstract and what happens in practice are two different things. There will be concerns about the effect on the economy of a wealth tax. It might reduce investment in the UK. Some high earners will leave, taking their high taxes with them. There will always be hard cases as well, which newspapers will exploit. Examples might be farmers, small businesses, widows in large family homes, and so on. So I think if a wealth tax is proposed, we can't assume that it will be capable of being implemented.
Indeed. Well, that all seems much food for thought in the current environment then, Emily.
Thank you very much, Simon.
Thanks.